Quick question. Before we even get started, what's the longest recession that has ever happened in Canada? How long has it lasted?
I actually don't even know the answer to that question. I should, because I'm like the recession guy. But if you're asking Canadians off the street, most people are going to say something like probably like 6 months, maybe a year.
Yeah, and you know what? The answer, depending on which recession you're talking about, could literally be anywhere from 2 months to over 2 years. But here's the kicker. The economic recession ending doesn't always mean that you are in a recovery or even a real estate recovery. In the 90s, for instance, the recession that lasted about 2 years, but Toronto home prices kept falling for about 6 years after that. It took 13 years for prices to get back to where they were in 1989 when that whole thing started.
13 years. Let that sink in. And if it was adjusted for inflation, I think it was like 20 something years. So you bought a house in 89 in Toronto and you didn't see your money back on the nominal price, unadjusted for inflation, until 2002? Yeah. Crazy.
Wow. That is a long time to be waiting. And look, I don't think most people know or understand that. You hear the word recession, they think it's like, this short, painful kind of pinch or maybe a little punch to the jaw of the economy. You get hit, you go down, you get back up. But the reality is much more nuanced, especially for real estate investors or people with a lot of real estate exposure.
Which is why we're doing this episode. So welcome back to the Canadian Real Estate Investor Podcast. I am Daniel Foch.
And I'm Nick Hill, and we're going to be going through the full nerd history of Canada's economics and the recessions and maybe how this is going to affect your portfolio. We've done a couple episodes on this before, Dan. I think it was actually like our second episode where it was how does Canadian real estate perform in a rising rate environment. So if you want to even deeper dive into like every recession and the exact real estate prices, go check that one out. This isn't that episode. This is a bit different. We're going to cover a lot of the major recessions, but we're only going to start this one kind of in the 80s. We're going to talk about how long they lasted, what they did for real estate, and very relevant to right now, what kind of takeaways can we apply to this kind of recession that we're in, that we're not admitting we're in, Dan?
Not technically. About. Well, it is interesting because, we saw, I've been super wrong on my recession calls, by the way, and I'm glad to admit that, but I am like, it's good to not be in a recession. We've been in a per capita recession for a couple of years, but we did have 2 separate quarters of declining GDP last year. Q4 being the most recent one, Q1 so far is positive. So we could see if Q1 contracts and we're in a recession technically, right? But the other interesting piece of the puzzle is, oil. And anyway, we're going to talk a little bit about it. So stick with us because this one's got some stuff in it that genuinely surprised me when Nick and I were putting it together.
Yeah, Dan, I'm happy you brought that up. It's hard to talk about Canadian recessions or honestly even recessions in general without talking about, one of the major signals. And it's kind of this uncomfortable pattern in economic history that once you see it, you kind of can't unsee it. And that is oil and major price spikes in oil, usually, trace back to some sort of crisis. Then it is a recession that follows that kind of activity, right?
Yeah, not sometimes, not occasionally, almost religiously. You go back through the data, and I'll pull up a chart for those of you who watch our videos. 1970s oil shocks, the early 80s, 1990s, 2008, even more in recent cycles. And, this is where I don't really buy the idea when people say, oh, it's going to cause inflation and we're going to see interest rates go up. I think the actual outcome, and Simone and I just did from the Canadian Investor Podcast, we just did a whole live session on this for a little crossover show that we're going to be starting to do Friday lunch lives, and they're going to be posted on the Canadian Investor Podcast channel. When oil prices spike hard and fast, it acts like a tax on the entire global economy, not just Canada. It actually ends up being net better for Canada, because then not everyone else, because we have oil, and we're going to talk a lot about this stuff in some other episodes as well. But consumers spend more on energy. Businesses face higher input costs, margins get squeezed, demand starts to crack, and eventually something breaks.
Yeah, and what's interesting is that it's not just that price level, it's that kind of shock factor, right? The speed of which it happens and the speed at which reaction happens, right? When oil jumps aggressively in a short period of time, economies don't have time to adjust. It kind of hits you like a hammer, and historically that hammer has been pretty consistent, provides a pretty consistent outcome, slower growth, and a much higher probability, if not almost a guaranteed, recession somewhere in the world.
Yeah. And, there was this Bloomberg article where I'm pulling the chart from that basically shows that there's a surge in energy prices suggests a high probability of recession. And there's further research that everybody seems to be talking about this right now. So investing.com just put out oil shocks and recessionary outcomes. And
right on brand. Look at that. Right on trend.
Yeah. And then the Financial Post just put out this one that says the billion barrel Hormuz oil shock is about to crash demand. Right. So this is from Bloomberg and the Financial Post. And so, the majority of major post-war recessions were preceded by oil spikes. And you mentioned how like the economy doesn't have time to adjust. During COVID, like people point to COVID and they say, oh, that's what we're heading for, right? When we saw that inflation go to like 9% and rates had to go up. This isn't that, because that took like 3-4 quarters, like a year to get for inflation to go from like 2 to 9%. This is like in a couple of months for inflation to jump way up. And so what happens is when you see headlines right now talking about supply disruptions, geopolitical tension, potential checkpoints in the Strait of Hormuz, you shouldn't be thinking about oil. You should be thinking, what does this do to the economy 6 to 12 months from now?
Yeah, that's so well said, because by the time that recession finally shows up in the data, we might have felt it as consumers, as Canadians, as investors, but by the time it shows up in the data, the move that caused that has definitely happened months before, right? It's just like all the other issues we face with this show, Dan, a very data-driven show, is collecting real-time data is near impossible, right? I mean, it's always lagging.
Yeah. Yeah, and that's why this episode matters right now, because if oil shocks really do precede recessions, and the data suggests that they often do, then understanding how recessions actually play out, especially in real estate, and your beloved rates finally coming down, becomes incredibly important.
Okay, so the great preface, let's like dial this back and kind of start at the very beginning and really just start with the basics here. Like, what is a recession? Because I think there's a ton of confusion about this. Like, in particular, what makes Canada's definition different from maybe our neighbors to the south or other countries around the world that we might look to?
So, yeah, most people have heard of the textbook definition, right? 2 consecutive quarters of negative GDP growth. That's what your high school economics teacher probably told you.
Yeah, and that's actually the kind of American shorthand, okay? In the U.S., there's this organization called NBER, that's the National Bureau of Economic Research, and they're the official people that basically go and say, hey, the recession started, the recession finished. Kind of a cool, weird job, but they use much more like a much more holistic approach. It's not just those 2 quarters of GDP decline. They look at things like employment, income, retail sales, industrial output, a lot more of the data you'd think that we should be including as well, right?
And Canada has the equivalent. It's called the C.D. Howe Institute Business Cycle Council. And C.D. Howe, friends of the show, we've had them on the show a couple of times before. They are the ones. That's actually kind of cool. The people who call the recessions in Canada, we've had on the show. There you go.
Dan, that might be a good retirement gig for you finally when you get there.
I'm like Rosie, man. I'm too early and too wrong. I'm pretty good at most other things, but the amount of times I called both times we saw a declining quarter of GDP last year, I'm like, oh, this is it. We're in a recession. We're going to get 2 back to back. But because of the trade volatility, because it was like tariffs on, tariffs off, war on, war off, election on, election off. It was like, it's hard to
making my head spin. Yeah, no, for sure. And look, especially when you put a definition to something like that, right? It gets pretty interesting. And we define C.D. Howe, as in we Canadians define a recession as, I'm going to quote directly here because the language does matter, okay? A pronounced, persistent, and pervasive decline in aggregate economic activity. The 3 Ps, Dan. Say that fast. Persistent, pervasive.
The D in C.D. Howe is Dr. Seuss, man.
Yeah, seriously. Okay, but look, what does this mean practically, all right? If they're looking at whether the decline is severe enough, long enough, or broad enough across the economy to actually count as a recession, it's not just one number, which is why it's those 2 quarters of negative GDP growth. Technically, that might not even be enough sometimes to really gauge what's happening and why sometimes an economy can be in rough shape currently, and without even officially getting that stamp of approval that we're finally in a recession.
Yeah, it doesn't feel like a stamp of approval to me. Sounds like you can buy this good, right? Like that's not a good trophy.
No,
but yeah, they built a scale for this basically. So they took inspiration from like the hurricane scale. So category 1 through 5. Category 1 recession is a mild dip. Category 5 is full economic chaos, prolonged instability. Think like Great Depression territory.
Yikes. Yeah, I mean, look, and this is useful for investors, right? I mean, we want to know this stuff. All recessions are not the same. understanding the category of that recession can actually matter, and knowing kind of technically where we are than just being like, okay, things are bad right now. Well, how bad are they?
Yeah. I mean, there's fast and deep recessions, kind of like COVID, quick, like it was over quick because they stimulated us out of it. And then there's like long and slow ones. But how many recessions does Canada actually have? Because I feel like people, I mean, I guess they're often spaced apart and like, they come in very cyclical nature. So like you don't maybe see a lot in your adult life, but I feel like people think it's been pretty rare.
Yeah, you know what? It depends on, I guess, what you consider rare here, and this is kind of a funny number here, which makes me even think we should just declare a recession even faster because we are at unlucky number 13. We've had 13 recessions here in Canada between 1929 and 1922. Average duration of the recession, about 11 months. So just under a year, I mean, basically called a year. And that average is pulled in a lot of directions, depending on which era you're in, right? Because obviously some of the effects of that recession can be felt a lot longer than the actual first hard-hitting month or whatever.
Yeah, actually, did you see that Canada M2 chart that I posted? Like M2 looks like pretty recessionary. I'll pull it up for those watching. But yeah, I mean, I think the trend here is important too, right? I'm going to pull up the chart of all the historic recessions since the 1900s as well. It's crazy, like when you contextualize just how bad the Great Depression was on that chart, like to see how deep it was and how long. But recessions have been getting less frequent over time because we've kind of been inventing new tools to deal with it. Like, before central banks just had like the blunt tool of interest rates. Now they have quantitative easing so they can control the money supply quite a bit. But, when they do hit, they've been getting more severe in terms of speed and depth because their flow of information is a lot faster.
Yeah, no, exactly. I mean, I hate to keep talking about COVID here, but obviously the most very relevant in today's day and age, the COVID recession in 2020. Perfect example. It was the shortest recession since the Great Depression, about 2 months from peak to trough, from start to trough, but it was also the deepest, right? GDP fell off a cliff in a matter of weeks, no surprise there. No one was allowed to go anywhere or do anything. The speed was unlike anything that modern Canada had ever seen.
The interesting part, though, is if you look at this, the growth coming out of recessions is often pretty big too, right? Like much bigger than.
Yeah, let's hope that's the case.
As we start to get, but this whole thing kind of flips the conventional wisdom, right? People think short recession, no big deal, but short doesn't mean painless.
Okay, so let's get to the specifics. We're going to walk through the 4 major kind of more recent recessions that all of you Canadian investors, real estate investors, professionals should understand. The 80s recessions, the 90s recession, the 2008 financial crisis, 2020. For each one, we're going to look at how long it lasted, how deep it went, what happened to real estate, and what lessons we can pull from them, from that era to apply to today's troubles. Dan, start me off.
All right. Let's start in the 80s. I wasn't born yet, but Nick, I'm sure you remember that period of time fondly.
Okay, chill. I had 1 year in the 80s, 1989. Great year. But look, this one's fascinating because the 80s recession was almost manufactured, right? Like the Bank of Canada deliberately jacked up rates to crush inflation, runaway inflation at that point. Prime rate in Canada hit over 20% in 1981. 20%, Dan. We've got people crying about, rates in the 4s and 5s and 6s. 20%? Crazy.
It's funny. I want to say that this would be like unthinkable today.